And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, here on Protect and Grow and helping us do just that with our money so that we can achieve our important financial goals. Tim, we always appreciate the time, the guidance, and insight. Thanks for being here.
Peter, thanks for having me.
Absolutely. And Tim, as you normally do, you've got a tip of the week to start us off.
I do. We're talking about de-risking with the market being so crazy, from the Iran war and that type of thing. De-risking is not taking out all the risk, but literally seizing on opportunities that are out there.
All right. Well, Tim, I normally would think of de-risking as abandoning a little bit of opportunity. Is that not the case?
No, it's not. It's about being a little smarter with your money and taking out some of the risk, but also looking for opportunities, depending on your age, what those can be.
So maybe the terminology or the connotation behind de-risking is a little misunderstood.
I think that's easy to say, especially when you're in the retirement phase of things or going into that, it means evaluating, market risk, income risk, longevity risk, even tax risk, healthcare risk, and legislative risk.
And does the timing of de-risking matter for us? Should we be looking at the market as we are considering de-risking?
Of course. Yeah. I mean, definitely that is one area that you're going to want to look at what your market exposure is, especially as volatile as the market has been.
Okay. So, how do we know when to begin the process then, Tim, of de-risking a portfolio?
Well, I would tell you the timing is such that you should be looking when you're getting ready to retire. Life changes like that are always majorly a time that we are telling our clients, hey, you're not putting more money back into the market. We need to, capitalize on what we have.
So more our time, our life experience and timeline and time horizon rather than where the market may be day to day.
Exactly. Yeah. You're not just looking at it by the minute, that type of thing. It's more about you.
Recovery time gets narrower and narrower, right? A 30-year-old has plenty of time to recover from a market downturn. A 60-year-old, maybe not quite as much.
That's exactly right. But that being said, we have people coming in here who are baby boomers that are investing like they're 30 years old. And that gives me pause.
Well, you did mention several different areas that could be encompassed within the conversation of de-risking, but I want to go to the one, Tim, that I think our minds naturally go to when we talk about financial risk, which is the market, and reducing exposure to market volatility, I think is what people innately, think of first when you talk about de-risking. So what might de-risking from the market volatility involve?
Well, I mean, you could be looking at cash and money markets. You could be looking at bonds and fixed income. If you're looking for income generation, lower volatility than equities, even CDs and treasuries, interest rates are pretty high right now still. Dividend-oriented investments. And then, of course, even annuities and guaranteed income products that can set you up like a pension, like a lot of people had back in the day. Now only 15% of society has that. And I think a lot of society still wants that.
But Tim, we don't want to abandon all hope and swing all the way to the other end of the spectrum either. If we look at inflation over time, we need a little growth on our money, right?
Exactly. Every strategy has trade-offs. Stability often reduces the upside potential, so there's a give and a take here. The right mix depends on your goals.
Which is going to be determined by the plan, what the right mix is. And as we are talking about making this transition to retirement, Tim, and the shortening time horizon, that time horizon is until we start needing income and making withdrawals from our investment portfolio. I heard it said when we have an income, we need an investment plan. When we have investments, we need an income plan. That's a big transition. The money's changed directions, but specific income planning, you have talked about being one of the ultimate ways to de-risk a portfolio.
Income planning, it reduces stress, especially when the markets take a hit like this. You're not worried about where your payments are going to come from. Stability protects your lifestyle. Predictable cash flow, it builds confidence in your retirement. These are things that we preach here all the time because I've seen the other side of the fence where people are worried about what the stock market's going to do and what impact that's going to have on their retirement is mind numbing. I don't want to see that on people anymore. So we make sure that when we do a protect and grow plan, that we're building that in there.
And there are other components that are not market based within that income planning as well. The Social Security, the pensions, and the annuities that you mentioned. But a lot of times people are basing at least a portion of that income on something that's volatile and outside of our control with market based investments and equities.
Right. I mean, and that's part and parcel with all of that is that you need to make sure that you're taking into account all that.
Tim, you did mention that the market was not the only area where you are helping people address, understand, and de-risk their portfolio. You have talked often on this program and emphasized the fact that tax is another opportunity. Tax planning, tax management, essentially, this is de-risking our portfolio as well.
I marvel when I ask one of my workshops, what is your biggest cost in retirement? And I'd say about 90% of the class will say healthcare. Oh, and in fact, it's taxes. We built this big tax time bomb where, we've kicked the can down the street. So we've got this huge 401k that's never been taxed. So de-risking would be also reducing future taxable income, creating tax diversification, i.e. Roth conversions. It increases flexibility. The strategies that we're talking about are, again, Roth conversions, strategic withdrawals, asset allocation planning, managing your RMD exposures.
Tim, you can help quantify this for people, right? I mean, you've got advanced planning software that shows and quantifies what the tax bill might be and what we could bring that down to and can help somebody understand that and compare it side by side to identify the strategies.
Well, we have a great website, mvpcfp.com, that we can actually prepare a report for people that tells them exactly what their taxes will be in retirement that most people don't have a clue. And we're always able to do that for people. It's a really straightforward report that we're able to do for people.
Again, you can start that at mvpcfp.com. mvpcfp.com, like most valuable planner, certified financial planner, mvpcfp.com. And that is the retirement tax bill calculator. Now, Tim, a lot of people are surprised by how much taxes are kind of already slated, but the additional risk that can be addressed through tax planning, tax management, Roth conversion strategies is legislative risk. Like, yes, we're paying higher taxes than we'd like to, but what if they change the rules on us in the future? We could be subject to even higher taxation if we have not taken control of this risk.
Well, as we've been told by our parents all along that you're going to be in a lower tax bracket when you retire, but in fact, most people tell us in our classes taxes are going up, and that blows that right out of the water. So tax rates change, retirement account rules change, your deduction opportunities disappear, Social Security or Medicare rules evolve. If anything, the one constant is change.
Tim, when you are helping somebody through this process, and whether it be market risk, tax risk, legislative risk, longevity, inflation risk, how does the stress and fear and emotional level change as you are addressing these risks one by one through the planning process?
Well, I mean, you know, true de-risking, I should say, is looking at risk tolerance, what their risk capacity is going to be. And then a lot of times you're offering almost emotional comfort as well. A successful plan is one that you can stick through even in difficult markets. And I feel like our clients are able to do that because we have a plan.
Yeah, peace of mind definitely has a value.
Yes.
We do have a mindset of possibility. Like I want the highest possible growth, but at a certain point in time, perhaps probability becomes more important than possibility. But when is the right time to de-risk, Tim?
Now, no, I'm just kidding. 5 to 10 years before retirement, itself, major life changes, widowhood, widowerhood, health changes, and large market gains. Those are the times that we're talking to people about it.
You laugh there is a little bit of a joke, Tim, but right now is not a bad time to consider this either. I mean, look at where the market has been and where it's come and what's happened over the last 10 years. And I continually look at this and ask, well, can the next 10 years be as good as the last 10 years have been?
Peter, you have mentioned time and time again, every 7 years on average, the market pulls back, and we've been in a nice bull market for a long time with bounce backs real fast. I think people are getting a little bit gluttony is a thing here, and I think people are becoming way too comfortable.
Yeah, complacency is a thing there as well.
Amen. Yeah.
De-risking though, Tim, will help our portfolio be more resilient to conditions and market volatility.
I agree with that, and it makes it more sustainable, flexible, like you said, resilient, and it aligns with your goals when you have a plan, and balance creates confidence.
But it's not about giving up opportunity. It is about evaluating the balance between how much can I grow and how much risk do I need to take. And Tim, that is where you help people construct their personalized protect and grow written retirement income plan. It addresses all of the risks of retirement, examines the variables, the assumptions, the potential for that risk to impact us, and then helps to design a plan, recommendations, and implementation of how to address those risks.
It's not fear-based. It's actually strategy-based. And when done properly, it can protect not only your portfolio, but your income, your taxes, your legacy, and I think most importantly, your peace of mind.
Well, if you'd like to get that plan put together, ladies and gentlemen, the Protect and Grow Written Retirement Income Plan, you can get there and only there at TJ Stearns Inc. Pick up the phone and give a call now to Tim Stearns, CFP, 800-640-2256. That is 800-640-2256, 800-640-2256. The construction of that blueprint, your personalized blueprint, by the way, is at no cost. It is a complimentary service that they offer there at TJ Stearns Inc. So if you'd like to review, evaluate your current holdings, your investments, and make sure they align with your goals, your time horizons, your comfort level, and maybe take the opportunity to de-risk a bit, pick up the phone again, get that conversation started. 1-800-640-2256, 800-640-2256. Or you can go online, tjstearns.com, tjstearns.com. Give a call now, 800-640-2256. Tim, always a pleasure having you here on Protect and Grow Chicagoland Retirement.
Thanks, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.